Hello once again and welcome back to Infinite Banking Step by Step. If this is your first video in this series, you may want to consider going back to the beginning and starting there, as each video builds on the ideas from the one before. In the last video, we looked at some of the various riders that may be attached to a whole life insurance policy. Most of those are not specifically involved in the idea of infinite banking, but some of them are. Now, today we're going to look at some real life insurance illustrations from real insurance carriers on a hypothetical person. The focus of today's video is how to read and understand a life insurance illustration and some of the questions that you might want to ask when you're reviewing one with your agent. Without any further ado, let's get right into it. We'll start with what we're going to call Life Insurance Company A. All right, I will be clicking around in this document, so please be sure to watch the video as we move through this information to make sure you're seeing what I'm seeing. Okay, so we're looking at a life insurance illustration from Life Insurance Company A. This is a whole life insurance contract, and you've got some basic facts up in the top left area here for who this insurance policy is insuring. Other things being equal, life insurance costs will be lower at a lower age and higher at a higher age. But there are other factors such as occupation and health that can go into determining your life insurance premiums. This is just meant as an example. And the price is also going to vary for different riders, from different companies, for different contract types, etc. So don't feel like these are your numbers, even if you're a 40-year-old male, like our example. So as you can see, a male 40 years old, non-tobacco. So this is, in other words, a standard health rating. It's not better than standard, just a standard non-tobacco rating. The base policy, in other words, the regular whole life insurance contract before any riders are added, has a starting death benefit of $229,768. The term rider is a 30-year term rider, so it's 30 years of term insurance. This is what's known as a level premium term rider, so the cost is the same every year. There are other kinds, but for our purposes, we prefer to use level premium term insurance riders. So that is a $50,000 death benefit. Adding those two together would give you your starting death benefit before paid up additions or anything else happens in the policy. Now, the first thing that I say before we get into these numbers, I say this in every client meeting when I'm reviewing an illustration, is that everything in a life insurance illustration, tabular detail, which is what this is wrong. Okay, everything on this page is wrong, and I'll explain why. On the left-hand side, all of this data, we have the premiums. That is not what I'm talking about when I say that it's wrong. You're guaranteed to have a level premium. You're guaranteed to not have increases in price on a whole life policy. It's going to be what it is once the policy is issued. What I'm talking about is the potential growth numbers, which you will see in a tabular detail page written as guaranteed. So these columns are the guaranteed columns, and then the non-guaranteed columns over here. Some life insurance companies display different information in a different order. Be sure to read your headings and ask questions if you don't know what you're seeing. I've tried to be as descriptive as possible here to make this straightforward for you, the viewer. But the guaranteed column, or columns, guaranteed numbers are wrong because they assume no dividends ever. In other words, if this is a mutually owned life insurance company, then we're saying in the guaranteed columns that the company will never be profitable ever again after you received your policy. Now, as life insurance agents, we're not allowed to say that dividends are guaranteed because dividends are not guaranteed. However, the likelihood of no dividends at all ever being paid is ridiculously low. You think of these companies that have been around for 115, 125, in some cases even 150 years, and paying dividends every single year for that entire duration. To look at that and say, well, they probably won't ever pay a dividend again, even though they have through major pandemics, major wars, et cetera, et cetera. I mean, that's just unrealistic. But that is what is reflected in the guaranteed columns. The guaranteed growth of the cash value, the guaranteed growth of the death benefit, and then I have created and added a column to show yearly cash value increase. Okay, so that's guaranteed. The non-guaranteed columns, which I'll highlight here, are also wrong. Why are they wrong? Well, you'll see I've added some context. These assume the same dividend rate every year. Dividend rate is a very confusing topic and deserves its own video, but the very short version is that a company calculates a DIR, or dividend interest rate, and then applies that dividend to each policy in a particular way. They pay a dividend to some policy contracts on a different schedule than they pay it to another policy contract from the same company when the same profit is earned in the same year. It's not that you can take the cash value and multiply it by 5%. That's not how it works. And so be very leery if you see people discussing cash value growth in those terms. It doesn't matter what the dividend interest rate is from the company. It matters how that dividend is applied to your policy with your health rating and all of the other specific factors for your specific scenario. Okay, but the non-guaranteed columns assume the same dividend rate. In other words, the same profitability of the company every year. And that is wrong. It's not going to happen. They may have the same dividend rate for 2 years in a row, 3 years in a row, but it's going to change as interest rates change in the general economy. So, do not get attached to these numbers. The further out you go on either side, the guaranteed or the non-guaranteed, the further you are from reality. And that's just something you need to be aware of as you look at this. Now, you might be thinking, and if you look back to our first video in the series where I talked about the idea that you might need drinking water on a day-to-day basis more than you need to build a lake and accumulate a huge pool of water that's very far away from you and hard to access. Well, this is something that sets a whole life policy apart from something like a 401k, a 403b, a Roth IRA, a SEP, etc. This has guarantees. No matter what the economy does, this policy will still grow. It will grow every single day within a year, but the illustration only shows year-end numbers. Okay, that's some more preface information before we really dig into this. But let's start looking at how this is designed. Premiums in year. So the way this policy is designed is for ease of reading. We're going to pay $10,000 in total premiums for 30 years. So here's the end of year 30 right here. Our example person is 40 years old. So at the end of the first year, they'll be 41. At the end of the second year, they'll be 42. So there's age. There's the year counter. Here's the premiums in year. Now, this particular policy is designed to be reduced paid up after 30 years. So that's why there are no additional premiums after 30 years. The policy contract would have premiums due, but we have reduced the death benefit at that point, in order to make the policy paid up. In the insurance world, paid up means there are no more premiums due. Okay. So the $10,000 total premium being paid is going to accumulate. So after 2 years, there's been $20,000 total paid in. After 3 years, there's been 30, etc. The $10,000 in each year is comprised of 3 components. The base policy, which in this example is $3,849 per year. The 30-year level premium term rider, which in this example is $151 per year. Those two add up to $4,000. Just to make this simple, we're assuming that these add up to $4,000, so that's 40% of the total premium. And then $6,000 is going to the paid up additions rider, which is 60% of the total premium. In your situation, you may have 30% base and 70% paid up additions. You may have 50% base and 50% paid up additions. It may be something very specific like 29.2% base. What matters for this discussion is just to recognize that's how the premium is broken down here, not to say that a particular rate is better than a particular other rate or ratio. Okay. So you can see no more premiums after 30 years. But what happens over time? Well, you put in your first $10,000 premium. The death benefit has already grown because when you buy paid up additions, you are growing the death benefit. The death benefit and the cash value are the same thing. You will see people on social media talking about how you should get the least amount of death benefit with the most amount of cash value that you can. That is a ridiculous statement because the cash value and the death benefit are the same thing. If you follow those two columns, this is the guaranteed cash value and death benefit, or these two columns, and it's the non-guaranteed cash value and death benefit. At the end of the contract, the very final year, which in modern life insurance policies is age 121, they are the same number. The cash value is the discounted net present value. It's the present value of the death benefit that must be paid when you pass away or when the policy is over or matures. So that's why they become the same number at the end. Okay? So to say that you want to only get cash value but not death benefit is a contradiction. It doesn't make sense on its own terms. Okay, with that out of the way, let's look at this. This policy has dividends that are what some people would say quite low at the beginning for the first several years. Okay. However, you want to note this yearly cash value increase. You pay the $10,000, your cash value increases by, again, on a non-guaranteed basis, $6,164. Now, you might say, that's a terrible deal. Okay, but keep an eye on this. Starting in approximately year 6, you pay $10,000, but your cash value increases by more than $10,000. And that will widen over time. You can see, okay, then you pay $10,000 and your cash value increases by more than 3 times that figure. And then 4 times that figure. And then 5, etc., etc. Okay. And actually, after the 30th year, the premium is $0. So if you say to me, hey, if you pay me $0 and at the end of the year I'll give you $30,733, well, I'm going to say yes to that deal. You know what I mean? That's a pretty good deal. Now, in order to get to that point, It requires funding in the earlier years. That's a given. But that's some of the things that you need to look at to really see the benefit, especially over the long term, of one of these strategies. Okay. There's also net gain above annual premium, which is describing what we just talked about. In that year, the sixth year, there's only about a $7 gain. But then there's a $463 gain. And then there's, $11,000 more than was paid in that year. Once the premium is gone, once there's no more premiums due, you can see this is just pure net. It's wonderful. You'll see the death benefit growing over time. Now, this policy has a 30-year term insurance rider. That means that the death benefit on a guaranteed and a non-guaranteed basis will decrease. Here's the two columns, the two different death benefit columns. The death benefit will decrease in that year, and it's decreasing for two reasons. Number one, I already mentioned. We're making the policy reduced paid up. It will be paid up, no more premiums due, but the death benefit will be somewhat reduced at that time. That's why it's called reduced paid up. But also, there is a 30-year term rider. In this case, it's for $50,000, and that will go away. So the death benefit will drop $50,000 from the term rider expiring, and it will drop more than that from the reduced paid up taking effect. Okay. Again, your agent can answer detailed questions on these things. If you'd like to see how this relationship evolves over time, there's a chart that I've prepared at the bottom. So you can see here, the green is yearly cash value increase, and the yellow is the premiums paid. So the first few years, $10,000 is paid, and the cash value increases by less than that. But once that gap is closed, then your increases, and I'm sorry, I'm having a hard time here, your increases take off. And this is all happening whether or not you take policy loans against this policy, because I'm assuming the use of variable policy loans or non-direct recognition policy loans. You can see when you're 80 years old, or this person is 80 years old, they pay $0 in premium and their cash value increases $46,843 that they can access, no questions asked, to deploy for any purpose via policy loans. It's not too bad. Now, their dividend is not the same thing as their increase in cash value. The dividend down here at, let's say, age 80 is $31,238. Again, with all the assumptions that are baked into this, which is to say the dividend rate is the same every single year. But that's still excellent. And they could receive that dividend as a check, or what this illustration shows, they can continue to use that to expand the size of the policy by taking a $31,238 dividend and letting that continue to grow the policy. Their policy's cash value will grow by $46,843. Okay? If it was not used to grow the policy, their cash value would still increase, but it would increase less. Okay. Now let's look at carrier B. Okay, here we are on life insurance carrier B, or life insurance company B, and this is very similar, but there are some key differences. Life insurance carrier A has a, other things being equal, cheaper death benefit. So for approximately the same premium, their base policy is $128,761, And then we also have a term rider. Again, it's a level premium 30-year term rider for $50,000 of death benefit. So the death benefit on this policy is substantially smaller than the death benefit on the other policy. But there are other reasons that this policy is more attractive than the first one. Anytime you're looking at a life insurance policy, particularly a whole life insurance policy, if you're taking from something, you're giving somewhere else. If you're giving somewhere, you've got to take from somewhere else. There is no perfect policy. There's just the perfect policy for you. So we have the same individual, the same health rating, and roughly the same premiums. I'll highlight these columns here: the base policy, the 30-year term rider, and the paid-up additions. Again, it is roughly 40% going to the base policy and the term rider, and 60% going to the paid-up additions rider. Again, we have stopped the 30-year term rider and the paid-up additions after 30 years to try to keep our comparison more or less equal. But this particular insurance company does not benefit by making the policy reduced paid up. There is no increase in dividend growth or anything like that for making the policy reduced paid up. So therefore, we have continued to have premiums due for this policy until age 95, which is the full length of the contract. We're going to see some very familiar things as we go forward through the rest of this illustration, however. The cumulative premiums are going to go up by $10,000 per year until we're only paying a base policy, and then they're only going up by $3,856 per year. So you can see it's going to crawl up after that point, after the 30th full year, beginning of policy year 31. This company is much more focused on dividends. They do not have a $23 dividend for multiple years before the dividend starts to expand. If the dividend rate is the same every year, again, that's what the non-guaranteed columns mean, or that's what they show, then you can see it's $881, $1182, $1486, and it picks up much more quickly than the other insurance carrier does. However, for the same amount of paid-up additions, $6,000 in the first year, the cash value is guaranteed to go up less. I won't flip back and forth between the two carriers. Feel free to rewind. But the guaranteed numbers on the first carrier look significantly better. Now, again, there's still guarantees. A 401k or other retirement plan that is an investment and not a savings plan, they have no guarantees. The lowest possible value for a retirement plan is $0. The lowest possible value here has a nice table over time to show you if you pay your premiums, there are guaranteed values. This company is less focused on guarantees and more focused on dividends. Life insurance company A is more focused on guarantees and less focused on dividends. Which one is right for you? I don't know that. And that's something you have to discover with your agent. Okay, so we look at the dividend. You'll see that it becomes quite large, especially over time. And our net gain above annual premium becomes quite large, especially over time. Just like in the other example, the yearly cash value increase is going to become quite large, especially over time, etc. If we scroll down, you'll see a very similar, very familiar chart to the other chart. You're going to have your yearly increase in cash value in green going up, and your annual premiums that drop in year 30, which is the age 70 of the individual we're considering here. But it doesn't go to zero like the first policy does. It's just low. But again, if I'm 76 years old and someone says, hey, if you'll pay $3,856, then I'll give you $29,869. I'll probably take that every time I can get that offer. You know what I mean? So it's not to say it's a bad thing. It's just that this particular carrier is going to perform better if you continue to pay premiums, and those will expire, or those premiums will no longer be due after age 95. So that also drops to zero. Okay. So what happens, and this will apply to both insurance carriers, what happens if you have a cash value after you've been paying into your policy for 20 years, you have a cash value $277,773, and you would like to go buy a property to use as an investment. You want to rent it out. You can fix it up, rent it out. Well, then something happens to you. You take out this policy loan, let's say for $250,000, and then something happens. You pass away. What does the insurance company do? Well, they say, okay, the current death benefit is $546,782. We just sent you $250,000. So what is $546,000 minus $250,000? Oh, okay, we'll send you that amount. They'll just say, what is the current loan balance? What's the death benefit? Death benefit minus loan balance equals remaining death benefit. They'll send that to your family, and your beneficiary could be your spouse, could be your children, could be a nonprofit that you favor. Whatever the situation is, that's how that works. And so the point here is that you have access, liquid access, no questions asked, to a large initial cash value that increases and will become very large over time with diligent savings. And you can use that for any purposes. A bank may turn you down to get that rental property, but your insurance company will not turn you down because they won't even ask you what that policy loan is for. They'll just say, okay, and send you the money. By the way, these are the kinds of questions you should ask your agent while you're working with them. What happens if? What happens when? What if I do this? What if I do that? What if something happens to me? Etc. I hope you found the visual helpful. Now, I hesitate to show videos here on YouTube of policy illustrations. And why do I hesitate? Because the dividend rate is going to fluctuate from year to year. This year may look better than next year. Next year may look way better than this year. It depends on so many factors. There are policy contracts that will earn dividends faster. There are policy contracts that will earn dividends slower. There are policy contracts that will be paid up in 10 years. There are policy contracts that won't be paid up until age 100. There are different types of paid up addition riders. There are different terms for making payments into those riders. There are different levels of flexibility between insurance carriers. There are other health ratings other than standard non-tobacco, and that can have a profound impact on the policy over time. There are certain occupations, as I mentioned before, that might mean extra premiums. What if you want to have a waiver of premium rider attached to your policy? Well, waiver of premium probably costs additional money. If you have that rider on there, it becomes part of your total premium, and that is not adequately reflected in the tabular detail of a life insurance illustration. So your policy might look a little worse from a growth standpoint because you are taking a very important risk protection step to add a waiver of premium, which would cover your required premiums if something happened to you at some point in the future to prevent you from working for income. There are also different types of waiver of premium riders, as we talked about. And so there's so many variables that go into these things. And again, I said it before, but there's not a perfect policy. There's just the perfect policy for you. And the point is not to have the best policy, it's to have a policy in force that you can use to manage your cash flows as you live your life. The point is not to pay premiums to set aside money for some indeterminate future date. This is not an investment, it's a savings tool, and it's a savings tool that has a death benefit. If or when something happens to you in the future, you can make sure that your family is taken care of. We didn't even talk about what's the rate of return on the death benefit or the rate of return on the cash value. That's really not the point. The point is that you can solve a huge risk for you and your family, and you can solve the problem that we outlined early on in this series, which is, how do I stop paying interest to third parties that don't care about me and instead recapture that interest into a system that I own and control? If you have one of these policies, you are the owner, not the insurance company. You are the owner, and you are the one who gets to dictate how it's used. Now, it's really important to note here that we're looking at not technically a life insurance illustration. What I showed on screen is the data from a life insurance illustration and some charts and some extra calculations that I did. Your life insurance agent must show you, they're required to show you the full, original, unedited, unmarked up life insurance illustration. They can't highlight particular things, they can't cross anything out. They must give you the original life insurance illustration from the insurance carrier, provided by their illustration software that carrier uses. So if your review of an illustration does not involve that unedited PDF, that's not a legitimate way to sell life insurance. Be very, very careful of that. I could have typed any numbers I wanted to on the screen, and they could have been wrong, and you'd never know what you were signing up for without the original unedited illustration. All pages must be present, and it will probably say that on every single page. This is not valid without all pages. Just something to be careful of. I hope you found this video helpful. In the next one, we're going to look at how to actually deploy the cash value from your policy to buy things, cars, homes, investments, businesses, etc., etc. We're going to talk in detail about how the cash value works when there's a loan out, and we're going to talk about paying loans back. Thank you so much for watching, and I'll see you in the next video. Thank you.